What's up everybody, welcome to the Stocks channel. My name is Cory and today we're going to do weekly chart analysis of all of the indices and we're going to talk about where this bear market is likely going to find resistance. So first up, let's take a look at a weekly chart of the S&P 500 SPY ETF. So let's crack open this chart and see what's going on in the stock market today. Alright, just a real quick announcement is the Black Friday deal for BANC Trade Alerts is now live and you can pause your video player of exactly how BANC S Plus is absolutely crushing this market. Remember, the trade alerts are only for TQQQ and SQQQ. Alright, so last week in SPY we had a very bullish weekly candle, and if we zoom in here we could see the weekly candle did close back over the weekly 20 simple moving average. And we do have our downtrending resistance trend line that defines this bear market currently up there right around SPY 412. Now that is a negatively sloping trend line, so it will depend on when we reach that trend line of what level SPY is going to be resistant. So it could be anywhere between 410 and 412. And I do want to caution you, that is now only about 3% higher before we find very critical resistance. So the first thing I want you to know is that we are still in a bear market while we are below that resistance. And we are very likely going to find strong resistance there because the bears will not just roll over and die and give this market away without a fight. For that reason, you should be expecting plenty of volatility as we rise up into this resistance zone, and you should be expecting a very big battle between the bulls and the bears. This has been a very polarized market between the bulls thinking the bear market is over and trying to get these very epic bear market relief rallies, and then the bears quickly reminding the bulls that the bear is still well and alive and this market has not yet bottomed. So do expect plenty of resistance up at that resistance trend line, but I do also want to caution you is that we are already at a critical resistance on SPY, which is going to be this level right around 400. So for that reason, you should be getting a lot more risk off around SPY 400. And if we do break above 400, then we should be able to reach that trend line right around 410 to 412. So right now, be very cautious if you're bullish right around this resistance at 400. And then if we break above that, you'll be getting cautious yet again right around 410 to 412. Now to the downside, this support zone right around 390 is exactly where you need to set your risk as bulls, because you only should be bullish while SPY is above 390. As soon as SPY breaks down below 390, that opens the door to come back down to retest the lows. And we are still above a rising 200 weekly simple moving average in the 360s. So we could still say this is a secular bull market while SPY is above that level. Remember, I'm defining a secular bull market as a market that is above a rising 200 weekly simple moving average. And a secular bear market is going to be if we start breaking down below that level and then start trending down towards SPY 318. So in a very symmetrical market, we would expect to find this bear market getting resistance around this zone between 400 and 412, and then continuing down for that next leg lower, which would be the leg lower below SPY 350, which would be right around 318 to 320. Now there is no guarantee this is going to happen, but this is the expectation as long as we're in a bear market. So this is the expected path as long as SPY is below this declining resistance trend line. Remember, I always try to remind you this is a downtrend until it's not, and this is a bear market until it's not, which means it's on the bulls to prove everything. This is a bear market until the bulls prove that it's not. And what I'm talking about when the bulls have to prove it's not a bear market is we need to get that decisive bullish breakout. The bulls need to turn that level into support, and we need to continue this trend of higher lows and higher highs. Otherwise, the bear market is not over, and this is just going to be another lower high before the next lower low. Now, while we're above the rising 200 weekly moving average, and especially while we're above SPY 390, you can stay bullish on this market, and in the short term, we are in a bull trend. I will remind you though, we've had plenty of short-term bull trends within this bear market, and of course, they've all ended with another lower low, and that is exactly why I want to remind you that you are still in a bear market, and this could just be the next lower high. Now, obviously, we're going to let price action do all of the talking, so if we do get the bull breakout above the resistance trend line, we will instantly get more bullish of the possibility that the market bottomed. Remember, we're not trying to guess whether or not the market bottomed. We're waiting until the market proves it to us, and we are going to continue to take long trades when the risk and reward ratios are there, and then we're going to get a lot more risk off and consider taking short trades as we get into the risk reward ratios that favor the bears. Remember, it's not about being concerned about winning or losing a trade. It's always about risk management, and you should not be taking on too much risk as a bull as we approach resistance, because that is exactly where the bears are going to take on risk, and that is exactly why we're likely going to see turbulence in the market as we approach these strong resistance levels. So watch that critical resistance at SPY400 and instantly get a lot more bullish about the price action this week if the bulls can push through that resistance, and then you'll be getting a lot more cautious as we approach the resistance trend line. On the NASDAQ 100 triple Q's weekly chart, we could see we're also approaching very critical resistance, which is going to be this negatively sloping 20 weekly moving average, which is going to be right around 293. The triple Q's levels of 292 all the way up to about 295 is going to be very strong resistance that the bears are likely going to attempt to show up at. That is why you need to be getting a lot more risk off as a bull as we approach critical resistance. Now your risk level to stay bullish in the triple Qs is going to be right around 282 to 284 because that is the double bottom breakout on the daily chart, which is obviously a very bullish pattern that says we could go higher. Now we hit a lot of our other double bottom price targets in the other indices, but there's no guarantee you have to hit a double bottom price target. So you will want to manage your risk around that neckline breakout between 282 and 284 and instantly get a lot more bearish and risk off if we break down below that support zone. You could see the rising 200 weekly simple moving average on the triple Qs is right here at 276, and we've had plenty of chop around that level on the triple Qs, but we're using the S&P 500 to say that we're in the secular bull market because that is the 500 stocks that define the stock market. Remember, the triple Qs is very tech heavy, so we're not defining the stock market of whether or not the triple Qs are above or below that level. Now, as you can tell, this has been relatively strong support right here around 258. But if we do continue into the bear market on the triple Qs, we would likely start trending down towards the next level of support in the 220s. Remember, I'm not telling you this is going to happen, but this is the expectation as long as we're in the bear market. And right now, the bear market on the triple Qs is defined as long as we're below this resistance trend line right around 305 to 308. If the bears keep the triple Qs below this trend line, we're going to continue to expect lower highs and lower lows. And that is going to remain the expectation until the bulls prove otherwise, which is going to require the price action to get a bullish breakout. On the Dow Jones weekly chart, you can see the Dow Jones is looking very bullish and we're getting very impulsive weekly candles. But I will caution you, the Dow Jones only has 30 stocks in it, and a lot of them are getting very overextended, so there is a very good possibility this is going to end up being a false breakout. If you look at where the Dow Jones is finding resistance, it's at this previous weekly close at 338, and we are getting up there too fast, in my opinion, which is going to increase the probability the bears are ready to strike, and there's going to be a lot of bulls that FOMO'd into this rally that are going to get burned. Now, if you look at the resistance trend line that defines the bear market in the Dow Jones, we are currently above that level, so we have to respect that. But if you look at the other indices, we have not yet had the bullish breakouts. And remember, the market is going to move as a whole. So the Dow Jones getting the breakout is not enough at this point in time for us to say we need to start getting overly bullish on this market. Now, obviously, if the Dow Jones continues higher above 338, that is going to be a bullish breakout. But I still think it's just getting way too far extended and it's just going too far too fast and due for a cool down. So look for that strong resistance at 338, and then above 338 we're going to have the next resistance right around 348. To the downside, we're looking for support around the breakout level around 332 and the previous weekly high right around 328. Now the elephant in the room is the weekly gaps in the Dow Jones, and I'm telling you right now it's very difficult to find weekly gaps that haven't been filled. And we have two weekly gaps in the Dow Jones at 311 and 285. So in a very real possibility of this bear market continuing, we are going to see the Dow Jones getting some type of double top off of 338 and coming all the way back down here to start filling these gaps below, with the first gap being 311 and then the second gap being 285. Obviously, if the bear market wants to continue to extend lower, we can go to the 50% retracement at 275. Now in the Dow Jones, we also have a rising 20 weekly simple moving average, which can act as dynamic support. So we're also going to have to consider that as well if we do indeed start to get a pullback. But remember, we're looking at price action and we're taking it day by day and week by week. And right now we could see some very critical resistance levels on the weekly charts on the indices. On the Russell 2000 IWM ETF, we can see the weekly chart is also at very critical resistance, which is going to be the bear market resistance trend line and this Fibonacci retracement level right here at 188. If you're following my daily chart analysis, this was also the double bottom breakout price target at 188, which was also the gap fill. And we did fill that gap on Friday and instantly found resistance. So if you just look at all of the indices, we have what could be a false breakout in the Dow Jones, the SPY, the triple Qs, and the IWM all at very critical weekly resistance with very great risk reward ratios for the bears to start stepping in at. So I do expect a very volatile week ahead. and I do expect to see the bear trying to take another bite. Remember, that doesn't guarantee the bear will be victorious, but the bear does have the advantage of the strong downtrend in the bear market, and it's on the bulls to prove everything. So in the small caps, you definitely don't want to be getting bullish right here at 188. You want to wait for some type of bullish confirmation of a breakout above 188, and then we could see the small cap start to run up to the next resistance at 200. So as a bull, you need to be risk off at 188, and you need to be managing your risk down here right around 183 to 180. Or you just need to stay risk off until we get the bull breakout. So as you can tell, this is a very critical week ahead, and we're not making any assumptions on who's going to win the battle, but we do know the bears have the advantage. And if you're trying to be bullish on this market right now, you just need to manage your risk. And of course, if you're bearish on this market, you still need to manage your risk because there is the chance the bulls blast through resistance. On the ARKK weekly chart, we can see ARKK is still well within this very strong bear market, and if I zoom out, you can see that we are at the March 2020 lows, and that is going to be that very critical support zone right around 33, which we are currently seeing a very impulsive bounce from. There's going to be very strong resistance right around 42 all the way up to 45, and you are not getting bullish on this ETF unless we can break out of this downtrend. You could take on risk using this risk level at 33, but if that level breaks down, you need to instantly get more risk off because there could be a lot more downside left in this ETF. Remember, we only look at the ARK ETF as profitless growth companies, and these are the companies that are very unlikely going to do well with a hawkish Fed, so try not to be overly bullish on this ETF, even though I do understand it is a retail favorite. On the VIX weekly chart, we can see the VIX has been getting obliterated, and it's coming all the way back down to the 200 weekly simple moving average, but I do want to remind you the VIX is consolidating and it's still been building higher lows. So there is still a very real possibility that volatility is going to come right back into this market once we hit the bottom of this wedge. Just imagine volatility coming down to the bottom of this wedge and then getting a spike all the way back up into VIX levels of 30, and you can instantly see how this bear market could be returning right around the corner. So just be very risk off as we approach resistance and as the VIX is getting too far extended to the downside, because we could be seeing volatility coming right around the corner. And then finally, let's look at a weekly chart of Bitcoin, because obviously there is trouble in paradise in the crypto world, and right now Bitcoin is losing that support zone at 19,000, which means it could be trending down towards the next support zone at 12,000. Now we do have the bullish breakout of the resistance trend line, and this could just be a back test of that trend line right around 15,000. But obviously if we continue lower, we could reach the price target of 12,000 by the end of the month in November. So just be risk off in Bitcoin while it's below 19,000, because if you're not accumulating this for the long term, this is obviously still in a downtrend. If you're accumulating for the long term, have at it, but do keep in mind it could be possible we go as low as 12,000. But I do believe if you're holding for 2 to 3 years, it really doesn't matter how low you buy it, as long as you're going to remain bullish for the next 2 to 3 years and you're not going to panic sell your position. So jumping back over to the S&P 500, this is going to be a very critical week of resistance, and I do expect to see the bears trying to take another bite because we are still in a bear market well below these resistance levels. Remember, we're only going to get bullish if the bulls prove it in the price action and blast through these resistance levels, but right now the risk reward ratios favor the bears and we are still in a bear market, so do expect to see the bears showing up. Remember, trading is always about managing your risk, so I don't care if you're taking long trades or short trades, you need to have a trade plan and you need to be managing your risk. This year has blown up a lot of traders' accounts because they had no idea how to manage the risk and they had no idea how to manage a volatile market. So make sure you're learning from your mistakes and make sure you're writing down your trade plan so you know what to fix if it's not working. Also, don't forget to take advantage of the Black Friday special deal off Bank Trade Alerts, where you can get 50% off 2 months of Bank S Plus or Bank. All you need to do is apply the coupon code Black Friday at checkout. Bank is absolutely crushing the market, beating all of the indices, including the TQQQs and the SQQQs, which is the only thing Bank trades. So take advantage of this special Black Friday deal now and try out Bank if you haven't already. And keep in mind, this is a limited time offer that will be expiring at the end of November. Also, if you're looking to become a better price action trader, consider joining the Stocks Channel Trading Discord community, where you get access to all of my intraday updates and analysis. You can find out how to join the Discord server by clicking on the link below. So thank you for watching, everybody. I hope you're crushing this market. And as always, I will see you in the next episode.